Hello and welcome to the Road to Autonomy. The Road to Autonomy is brought to you in part by Stantec Generation AV. Stantec Generation AV combines some of the most experienced AV experts in the industry with the resources of a global engineering firm. Stantec Generation AV provides education, consulting, assessment, and guidance to any industry interested in autonomous vehicles. Learn more at stantec.com. Hello and welcome to the Road to Autonomy. I am your host, Grayson Brulte. On today's episode, we're absolutely honored to have Dean Foreman, Chief Economist, the American Petroleum Institute, and Prentiss Searles, Petroleum Marketing Policy Manager, the American Petroleum Institute. Gentlemen, welcome to the podcast.
Thank you, Grayson.
Thank you so much.
Thank you for coming here because the petroleum industry plays an extremely important part in the global economy and especially in the U.S. economy. And Dean, to kick things off, I would love to know, what is the current state of the U.S. oil markets?
Well, in a nutshell, it's recovering along with the economy. I mean, we've got through the entire first quarter demand just within a hair of where it was on the pre-COVID levels. So, year-on-year changes are just a couple of percent down. There's less driving and less flying, but what's maybe not apparent to the average person is that there's a lot more freight transport and petroleum going into petrochemicals, for medical plastics, for personal protection equipment, for packaging. All of that is up substantially. So when we look out for this year and next, by the U.S. Energy Information Administration's expectations, their projections are for record global oil demand growth combined this year and next. At the same time as when we look at the industry, that drilling activity, it's up this year, but it's historically weak. And the industry's ability to spend within its cash flows to invest in terms of capital expenditures has also been historically low. So this has led to recent oil prices being around $60 a barrel, even as OPEC and Russia have redeployed a lot of their spare production capacity. So to recap, we've got historically strong demand, potentially record demand this year and next combined, weak drilling activity, weak investment. And that opens the question of just the extent to which the U.S. can participate in this recovery.
Is that what we see, the growth of e-commerce? And so that's what I'm assuming we meant with freight transport. Consumers all over the country are ordering record numbers of stuff online. We are no longer a net exporter of oil. We are now importing. Is that what's driving up these prices?
It really is supply and demand that's driving that. I mean, if you think of the way it's played out, the fact that we grew domestic oil production over the last decade really did break the stranglehold that OPEC and Russia together had formerly had over oil prices. And the U.S. ability to control its own destiny there has just cushioned U.S. consumers. Now, in terms of the financial impact of that, I mean, if we look at what the value was to the U.S. economy, the U.S. had averaged petroleum net imports of some $300 billion a year between 2008 and 2012. Yeah, that much. And it peaked actually in 2008 in nominal terms with no adjustment for price inflation at close to $400 billion. So fast forward now to 2020 and what happened? We were a net exporter of between $15 and $16 billion. So we've gone from imports of $300 to $400 billion a year to exports of 15 to 16, and potentially, if the U.S. energy revolution remains intact, the ability to grow that. So even if it didn't grow, you're still talking from a trade balance perspective, savings for the U.S. then of $300 to $400 billion a year, just in nominal terms. And the problem here is that with the damage done to U.S. companies going through this downturn this last year and having now less domestic production than we did, we've got the prices back up, but we have lower production, and hence, if our demand is recovering, we're going to have to import on the margin. So the U.S. EIA sees us returning to being a net importer for all of this year and for next year, and the data bear that out. When we looked at February and March, the U.S. was a net importer again.
It's a reversal. It seems like it will have a negative impact on the economy and also have a negative impact on U.S. consumers' wallets. And I was reading a report that we're heading for an oil shortage in 2022. If that happens, what are the implications from an economic perspective?
Well, we just discussed the trade balance. That's one part of it. Crude oil prices, they are the largest single input into making gasoline when we think about fuel prices, right? And currently, the EIA would estimate that crude oil is about half the cost to make gasoline and diesel fuel. So to the extent that oil prices rise, it could affect U.S. household costs for transportation, for driving, and for flying.
And then is there an economic chance that it could increase the cost of goods that are being shipped to those consumers' homes?
Absolutely. I mean, when you think of petroleum, and we just talked about how the petrochemical sector has really been booming, if those input costs go up, that affects everything through the entire value chain.
Prentiss, in 2020, 98% of new passenger vehicles sold in 2020 were internal combustion engines. If we do see this oil shortage in 2022, what would that mean for U.S. consumers?
Sure. So I think that the first thing to recognize is that gas is relatively inelastic, right? So people are going to continue to purchase the fuel. What happens, though, when we saw it in 2008, is that they are going to be a little bit more mindful of how quickly they do jackrabbit starts from the stoplight. They'll start making sure their tires are filled up. You can get pretty significant efficiency improvements by just making sure your car has air in the tires at the right PSI. And they are going to go in and start carpooling and getting things going that way. So, I mean, I think that they start being a little bit more mindful of what goes on, but ultimately they're going to still go where they want to go and be able to get there because there will still be product in the marketplace.
So in your analogy, basically a consumer could operate their car like it's a Nest thermostat. Okay, we get the right amount of air, and if we don't jump off the line there, okay, we're going to try and optimize this fuel efficiency?
Yeah, absolutely. People start to optimize and they look at, can I combine my errands to just get a little bit less miles on the road?
And do you see that opening the door for the potential of hybrid vehicles or plug-in hybrid vehicles where those tend to get better range from an EPA perspective as an alternative?
Yeah, so historically people have, kind of tended to buy, more cars that are more fuel efficient, but it's not as much as you might think. But I think that, hybrids are really impressive cars these days. There's one on the market that gets 58 miles per gallon combined average on the EPA, and it gets about a 700-mile range. So people will look at that, and if they're looking for a sedan, they will look up and go, a hybrid is where I want to be, and it makes a lot of sense. Additionally, I think people will continue to buy internal combustion engine vehicles. They still want to be able to tow their toys around. They need to be able to carry their kids to soccer games and football games and all those types of things. And so, people need to be able to choose what it is they're going to drive. And, I think that's, will they pick hybrids? I think they'll pick hybrids, and they'll also pick, the cars that we've always driven.
You're right about taking children to a baseball game or to a play. There's not a large enough vehicle that's not a hybrid or electric vehicle that can take a family of 4 or a family of 5. You still need that internal combustion engine to get your family there. And on the other side, from the business standpoint, we're seeing the economics of hybrids are starting to make a lot of sense now, especially over electric vehicles. And Brian Selesky, who's a really incredibly smart individual who happens to be the co-founder and CEO of Argo AI, stated the following in a February 2020 interview with The Verge. The way I look at it is hybrids are a good balance because the autonomous technology itself to drive a car consumes quite a bit of power, and this hasn't really been written about a lot. But there's a whole utilization that's important to make the business case work. We need the cars to be on the road earning money. To me, this is a practical approach that makes economic sense. What are your thoughts?
Sure. Well, hybrids definitely provide economic ways to achieve higher fuel economy. They combine existing technologies, and to the extent consumers choose hybrids, as Prentiss was suggesting, that appears to be a viable part of the energy mix, no question. Now, autonomous driving systems, per the quotation, they really do open a range of questions beyond those of just about the energy being consumed. So the real questions there are a learning curve in terms of human and machine interactions, the safety, the legal frameworks that go with it. And those are the things that really could be gating issues more than the system's energy requirements for autonomy.
Well, that's a valid point. I really love how Brian emphasized that we're building a business and that it has to be fundamental. We have to have a return for our shareholders. We have to become profitable to employ individuals. And you're seeing this, Dean, I want to stay on this theme with you. We're seeing this giant shift in society towards electric vehicles. 12 U.S. governors signed a letter today trying to phase out internal combustion engines by 2040. But it seems like this is being driven by policy, not necessarily by market demand. If this is going to continue, to a listener who's interested in economics, what impact will this have on their wallets eventually if the market doesn't decide it's driven by policy?
As a leading indicator, let's just consider really what's happened over the past decade. Before the pandemic and without any mandates for electric vehicles, expenditures on vehicles, their maintenance, their insurance. If we look at the U.S. Bureau of Labor Statistics Consumer Expenditure Survey, we would see that between 2009 and 19, that went up by about 18% for the average U.S. household. And if we adjust for price inflation, that's up 28% over the period. So transportation expenditures, other than any energy or fuels, rose nearly twice as fast as the broader pace of consumer price inflation. That's point one. The second is that if we start looking now at the demographics of this price increase, the rate at which vehicle expenditures rose was 2.5 times higher for lower income households than it was for the most affluent ones. So again, per BLS, the consumer expenditure data, this has a regressive impact. Now, to the extent that EV mandates or higher costs that get imposed on internal combustion engine vehicles impose even further vehicle cost increases, that's going to affect the affordability of vehicles to consumers and likely harm them and probably harm lower income households the most.
Yeah, just build on that a little bit and say that by having an EV, built into the, a mandated set of EVs built into the economy, that also impacts the number of vehicles that are available for the secondary market to purchase. So that ends up having an additional cost, and EVs are $10,000 to $15,000 more compared to an equal sized vehicle.
$10,000 to $15,000 is, it's a lot of money. I mean, if you want to do simple math, it's $1,000 a month. It's a lot of money that individual is going to have to make. And we're seeing the price of lumber go up, the price of housing go up, and this is just another expense. And it's really interesting when you look at policy that's driving cost. I was doing some research and I noticed that there was a council member in Tampa, Florida, who came up with the grand idea to ban fossil fuels and any new fossil fuel infrastructure in the city of Tampa. So I started looking into this, and I didn't realize that Tampa Bay supplies a large percent of the petroleum that comes into Florida. It goes into Central Florida, and for our listeners that might not be familiar with Central Florida, that's home to everybody's favorite mouse, Mickey Mouse. And that Central Florida creates a lot of jobs. You also have Universal there. And this runs over a pipeline. It's creating jobs, as Governor Scott once said. Dean, if this council member got this proposal through, it seemed like it would not only devastate the port of Tampa, but it would have a tremendous negative impact on Central Florida and the state as a whole. What impact would it overall have on Florida's economy?
So I'm from Tampa, so seeing a proposed policy like this was really quite alarming. The proposal may have come with really good intentions, the best intentions, but it wasn't well understood even by those who proposed it, and ultimately would have banned internal combustion engines. The mandate, which has since been withdrawn, it would have been fundamentally inconsistent with the state's existing fuel network, its transportation system, not to mention that many residents in the region are, travel to and from there seasonally. So this would be one way to really grind Florida's economy to a halt.
Staying on the economic theme, Dean, how many jobs are supported by the petroleum industry in the United States?
Well, it's safe to say that the natural gas and oil industry in total, that is direct, indirect, and induced employment, has supported more than 10 million jobs across the United States. The quality of those jobs is also hard to replace. The average salary in the industry can be as much as $50,000 above the nationwide average.
Those are great high-paying jobs that are allowing those individuals to send their children to better schools, move to a better neighborhood. It's having a really positive impact. And I want to highlight the fact that the petroleum industry is a stable industry. These companies have very conservative balance sheets, and they're able to hire and employ individuals, which is a really good thing. And it's a great industry for American Prentiss. I want to shift back here to passenger cars for a minute. What would the current state of the electric vehicle market look like if there were no subsidies? Would there even be a market today?
Well, sure, there certainly would. There are kind of two different thoughts on that, though, and I'll kind of hit both of them. The first is that people will buy EVs regardless of whether there is a subsidy, and those are the people that they have a desire to be quote unquote green, They think that it's the latest, greatest technology, so they want to have that. They also want access to the HOV lane. They want to be able to go to their local gym and plug in and maybe get a free charge there. So, if you go to the airport, you can also get a free charge. So all those things start adding up and they go, well, it probably makes some sense. And, so regardless of subsidies, those people are going to buy the cars. You also see that, when the subsidy went away, you had Tesla just lower their price by what the government subsidy was. And they continue to sell cars. And they're the most capitalized automobile manufacturer in the world. So those are the things that go towards that side. Anecdotally, you've got Georgia. And, Georgia had a $5,000 tax credit. And when they decided that they no longer wanted to have that much of a tax credit to the wealthy, because those are largely the people that buy EVs, the car sales in that state dropped off precipitously.
Yeah, to be exact, it was a 90% drop in EV sales the time the credit went away. The other interesting thing you pointed out about free charging on a previous podcast, I had Neil Golson from Flash Parking talking about the economics of parking. And one of their customers is Target, and they have EV infrastructure. He said, oh, by the way, there's no more free charging. You have to spend a certain amount of money to get a certain charge. And so he said that that's a shift that he's seeing throughout, this is for Flash, seeing throughout their customers, that individuals will come in there, oh, I got an EV, or I got a plug-in hybrid. Oh, I can park for free, and I don't have to shop there. And so the retailers say, wait a second, we've got to take the power back here. We're not just a drop your car and do what you want location. That's going to be interesting to see how that changes. And Dean, I couldn't believe this. You and I have talked a lot about economics. I read something in the Wall Street Journal yesterday where the large CEOs of the European auto manufacturers are trying to boost the sales of electric vehicles. And meanwhile, so I start taking a look at their balance sheets and I look at their profit and their revenue. It's mostly coming from large vehicles, SUVs, crossover SUVs. And these large, well-respected CEOs said, well, our EV sales aren't working, so we need the government to tax our SUV sales, which are driving our profits and supporting our employees. When did the shareholders say, wait a second, this doesn't make economic sense. I want my dividend. I want my relative to have their job here. Let the market determine the rollout of these vehicles.
So again, electric vehicles, as Prentiss was saying, really could and they should and will play a role in the auto mix, so long as they're competitive and consumers actually prefer and choose them. Raising internal combustion engine vehicle costs, on the other hand, that'll affect auto sales as well as household bottom lines. So look, they're going to hear it if consumers are affected, and they'll sell fewer vehicles overall. And they'll still see people start to substitute. They'll go for less expensive models. They'll go for, frankly, if they switch to less expensive models, those are the ones where the auto manufacturers make less profit per unit. So these are the risks. They're the risks that the auto manufacturers themselves, based on their investors presently, are gearing up to take. And they also, it's not just US mandates or European mandates, also to get access to the fastest growing market there in China. To play in that market, they have to have this technology. So that's part of the motivation, and there's no one piece to it. I think we should expect that this is going to play a role. But again, it is a big risk, and it's a huge transition that they're taking on.
But when do we return to free markets? When does the market decide?
Well, that really is the question, right? I mean, it's a broad question given the macro environment we've just experienced. And with the COVID-19 pandemic, we've seen unprecedented government and central bank coordination just to hold things together. Free markets have gone out the window in many different aspects as a result of that. So even if we start to look at emerging markets imposing policy constraints, consumers are ultimately going to be the ones who have to choose. Affordability is going to rule. And we have to have an embedded faith that consumer preferences will ultimately speak and that this will play out.
At the end of the day, consumers are going to vote with their wallet. If consumers decide we don't like this product or we don't like this widget, then you're going to have a problem on your hands if they decide to vote with their wallet. And that's ultimately what's going to happen. Prentiss, I'd love to know if return to, as Milton Friedman beautifully said, to a free market society, the U.S. became, God willing, a net exporter again, and all electric vehicle subsidies came to an end. What would the U.S. passenger car market look like, in your opinion?
Regardless, and I think this is an important point, regardless of how quickly EVs take off as a percentage of sales, in 20 years, the majority of vehicles are still going to remain an internal combustion engine vehicle. And so what we need to do is make sure that consumers have good choices that they can make, to Dean's point, when they are purchasing their vehicle and voting with their wallet, that you have a strong opportunity or a strong set of different products that they can walk into and go, okay, I want that one. And you don't want to stifle the improvements that happen with internal combustion engine vehicles. And you don't want to stifle those through the zero emission vehicle mandates. But, to your specific question of what would the passenger market look like, it's going to be a mix of different technologies. People are going to buy electric vehicles, they're going to buy hybrids, plug-in hybrids, internal combustion engine vehicles, fuel cell vehicles, and all of those technologies have opportunity to improve. And so it's really important that the consumer have that opportunity to go, okay, I can choose a vehicle that meets my needs and still meets the goals of society to reduce carbon emissions.
The idea of a mix of vehicles is like a beautiful symphony or a yo-yo ma playing the cello. It's absolutely beautiful because you're allowing an individual to make a choice with their own wallet. I have this vision that somebody has an internal combustion engine today. They might say, wait a second, I have a little bit of range anxiety. I'm not ready to get a full electric, but I like to have the idea of a battery. I'll get a plug-in hybrid, or wait a second. Okay, well, now we have charging infrastructure built. I'm confident that the grid is secured. Then I move on to EVs, and that's a beautiful transition that the market plays a role in. It's not being forced upon you. And Prentiss, staying on this, do we see a global divergence in vehicles where Europe is going all in on electric vehicles and perhaps the United States, we see a patchwork of laws where in one state you might have a beautiful mix of vehicles and in another state you might have electric vehicles? What do you think that this looks like and what is that path forward?
Yeah, so I think right now you're seeing some states, particularly California and New York, that are considering and moving forward with a internal combustion engine vehicle ban. And you've got the letter that you referenced earlier in the podcast that there's several governors that are also kind of pushing the federal government towards that end. But, our approach is that you should have a federal policy that's market-based that drives cost-effective carbon emission reductions in the transportation sector. And if you do that using a holistic approach, and what I mean by holistic is that you look at the vehicle, the fuel, and the infrastructure as a system, and you look at the carbon footprint of each of the different technologies and you say, let's figure out how these things compare so that we can get the best opportunity to reduce carbon emissions, and that we could do it in a cost-effective means. And if we can do that, we're achieving a strong economic goal and we're achieving the societal goal to reduce carbons. And we support a strong federal policy to do that.
Reducing carbon that makes economic sense is absolutely the way it should be done. And API's taken an incredible leadership position on looking at the economics while trying to reduce carbon into something that everybody should strive to, because at the end of the day, this is all going to boil down to economics as we all do good for society. We all love the environment, but it has to be done in an economic manner that's not going to have any negative impact on any member of society. And so, Dean, we've talked about this transition towards electric vehicles going from hybrid to electric. It's really good because we haven't really chatted about it. The EV infrastructure is not fully built out yet. In theory, it would give individuals and companies times to build out the EV charging network so an individual can go from, say, Tampa to Atlanta, Georgia, not having to worry about where can I charge. When we get to that future, what impact will that have on the petroleum market when consumers are really comfortable driving their electric vehicles in long distances?
Well, and let's repeat the key theme here. I mean, it really does come down to consumer preferences, and there are different dimensions here. It's a vehicle's performance, its utility, the consumer's brand preference, the aesthetics of the vehicle, the cost, and ultimately the subsidies that affect the cost, right? It's all of those things that are going to affect a vehicle purchase decision. So, in economic studies of what the impact could be, the cardinal sin, if you're going to do that kind of thing, is to assume the answer. And, with EVs, one can see that if we look at different projections that are out there by third parties, you've got projections that are all over the place. And depending upon what assumptions are made about consumer preferences across those different dimensions, you come up with different answers. Now, directionally, we can say the impact of EVs going in, it should, as they grow, it's going to force higher efficiency internal combustion engines along the way. You'd think that you've got some substitution for petroleum products along the way. And as those alternatives, it's the most cost-effective ones, the ones that are chosen by consumers, that are going to win. So the broader economic impact is really going to turn. It could be positive based on consumer preferences as opposed to inefficient mandates ruling the day there. Now, the fine line here is between having money that kickstarts a new technology, so research and development that takes off, these things start to grow, the costs come down. That's a different outcome than you get if you put policy mandates from the top down that basically mandate a winner and a loser in terms of technology. And it's when you get those discrete blanket regulations that you start to have costs that affect the broader economy in a really negative way. You strand certain parties. To weigh in on the previous question that you asked, Prentiss, if you're comparing Europe's path versus the US, Europe, if you were looking at what they did with cell phone technology back in the day, they basically mandated standards. Japan did the same. And lo and behold, they had faster penetration, greater penetration, and lower costs for cellular service as a result of that. And here we are, they are also taking a different path with electric vehicles and charging infrastructure, publicly funded infrastructure, right? So they are mandating a standard for those things in terms of the plugs and the infrastructure, whereas the US, with the state patchwork quilt of regulations, has different standards in compatibility of adapters and plugs, still public funding for it, but it's a different kind of patchwork quilt of things as opposed to what you're going to get elsewhere around the world. And that affects the economic outcome that comes with it all.
I'm happy you brought up the plugs because you're right. There's no consistency. You're seeing company A decide we're going to build a proprietary network. Company B, we're going to build a proprietary network. Company C, we're going to build a proprietary network, but they're incompatible today. And I drive my internal combustion engine. I see Sunoco station, a mobile station, or a marathon station. I don't have to worry, okay, is this going to fit into my car? It works. And it changes the game because I have no stress. And I know when I'm going to go from, say, Tampa to Georgia again, I can get there. There's a lot of issues that still have to be done. And the other thing that the oil industry has done really well, I don't have to worry about the grid collapsing, where if everybody in my town decide to go to the gas station and pump gas at the same time, you can bring in a tanker and fill up with more oil. And if everybody decided to charge, well, I might not have air conditioning in my house in the middle of summer. That's not a good situation. We have to figure that out. And Dean and Prentiss, I'd both love to get your individual perspectives on this. What does the future of the petroleum industry look like?
I guess I'll start there. So, clearly never a more interesting time, right? And to reiterate where we started, the demand is solid and it's going along with the recovering economy, and we're near these pre-COVID levels, as discussed. The EIA is actually projecting that by the end of 2022, the world's going to be at a record high, a new high for oil demand. So that's really remarkable given everything that we've gone through. Now, emerging markets are the ones leading that demand growth, especially over the longer run. And for many emerging markets, we have an underlying issue of alleviating energy poverty. So the ability for people to move up the income chain to have many of the consumer goods that the rest of the world has is just a fundamental right to human and economic development that goes with that. So, look, oil and gas, if we were looking at the International Energy Agency's sustainable development scenario, so a scenario that's compliant with the assumptions of trying to stem greenhouse gas emissions and make sure that the world's on track to minimize the damage there. Even in those cases, oil and gas is still nearly half of the energy mix in 2040. So the industry as a whole has a viable future almost no matter what here. It's a question of where and how much to a certain extent. But think of it this way, from IEA standards, the natural decline in oil production globally is between 4% and 6% every year. And that range depends on how much you're investing to try to stem the decline. So in a roughly 100 million barrel per day global market, that's 4 and 6 million barrels per day every year that has to be developed new just to replace the natural decline. And if demand is growing, like it is this year and next year by a record amount, and EIA's projection there is about 9 million barrels per day of growth. That's a tremendous amount of growth and investments that's necessary for a pretty viable industry to continue. So we see a viable industry, but it's gone through a really difficult period here. And the question from a U.S. perspective is how to mesh record demand growth with really a dearth of investment in drilling activity in recent months up to a year. That has to play itself out in the longer term as you start to go through an energy transition. It'll find a way, but it's going to respond to prices. It's going to depend on the regulations and whether we get a price on carbon that affects the incentives that consumers have. And we need ultimately, as Prentiss was saying, as you've reiterated, cost-effective solutions. And it's really technology that's likely to be the key delimiter in which path we take.
Prentiss, your thoughts, please?
I'll just add a little bit. I'll rely on our chief economist to give you the future look of what the industry might look like. I do think, and I would just reiterate the point about energy poverty that Dean mentioned, because it's really a critical piece to bringing everyone in the world up to a standard where they have the opportunity to be educated and to, have great health care. Because when you have energy available by flipping on a switch, by turning on a burner, and you no longer have to go out and search for different natural products, whether it be wood or dung, you now have the ability to focus your attention on other things and be educated. And that brings everybody up in the world. And I think that that's a key thing that just often gets overlooked with the petroleum industry. But, I think the future of petroleum, as I mentioned earlier, you're going to have a tremendous number of cars that are still driven by internal combustion engine vehicles because it takes that long to ramp up the sale of EVs. Even if you assume they're selling like hotcakes, you still have 250 million vehicles that you have to overcome with the sales on a given basis. So I think ultimately what that does is say that we're going to be around for a long time, that we have a product that people physically need, and it provides a security of energy that people in America have come to rely on.
I agree with your statement, and I want to point something out that you hit the nail on the head, and we didn't talk about it at all, but kitchens. If you go into any famous restaurant, the top restaurants around the world, they have one thing in common. They all run on a gas stove. I love to cook, and there's nothing like cooking on a gas stove. That's how you cook a great meal, and that runs on natural gas, and that's a great thing that your industry does. And gentlemen, the petroleum industry and the natural gas industry is a completely incredible industry that does a lot of good for a lot of individuals around the world, and it allows people like myself to drive my daughter to school in our car. It allows me to cook a great meal in my kitchen. And Prentiss, as we look to wrap up this really insightful conversation, I'd love to know, what would you like our listeners to take away with them? Because petroleum and gas industry is a lot more than just gas in your car. It provides jobs and does a lot of really good for society.
Yeah, I think I would just sum it up to say that we are for a technology neutral approach to solving these issues. And we have just recently unveiled our climate action framework, which advocates for a set of policies to address the risks of climate change while meeting the world's long-term energy needs. The full report can be available and is available at api.org through our climate action tab. This last thing I would say, and I think it's always good to quote your CEO. So if you'll allow me to do that, Mike Summers said specifically, confronting the challenge of climate change and building a low carbon future will require a combination of government policies, industry initiatives, and continuous innovation. America has made significant progress in reducing emissions to generational lows, but there's more work to do. And there's nobody better equipped to drive further progress than the people who solve some of the world's toughest energy problems every day. As our industry accelerates efforts to advance groundbreaking technologies, reduce emissions, and drive transparent and consistent climate reporting, we urge lawmakers to support market-based policies that foster innovation, including carbon pricing.
Well, before recapping, I want to follow up a little bit on your last point about access to clean cooking fuels and especially natural gas. Little known fact maybe, but if we're talking about sub-Saharan Africa and who has access to either electricity or clean cooking fuels, it's only about half of the population of all of that continent or that part of the continent that has access to electricity, and fewer than 20%, 1 in 5 has access to clean cooking fuels. So that's really, really important in terms of trying to keep in perspective rich country problems versus emerging market and much of the rest of the world. So while we debate these issues, we have to be sensitive to the fact that people really are trying to fundamentally have human and economic development that's equitable across the world. And economic growth and controlling disparity in that, it comes along the way. So I think to recap, the thing is from the top down, with $20 trillion of economic stimulus globally so far through this crisis, the economy is coming back with resounding strength. And on a market exchange rate basis, if we use actual exchange rates to look at the way the economy is growing globally, we're looking at basically the only other period that's been stronger than this year and last is really 1972 to 3, right before the Arab oil embargo. So strong economy, strong oil demand coming back. And history shows that these U.S. expenditures that we've had on vehicles have risen and affected lower income households the most here at home. So policies that restrict consumer choices, they're likely to raise costs. And ultimately, we as policymakers and interacting with policymakers have to consider what are the cost-effective solutions that go to the root of the problem. And if the root of the problem ultimately in the long term is emissions, sensibly, both in terms of acceptable cost levels and who's paying the bills, we have to think of what are the right ways to get to that solution.
That's a really powerful statement and a really profound way to wrap up this conversation. And Dean, Prentiss, I thank you two gentlemen for coming on and sharing your insights with the audience today, because the future is bright, the future is autonomous, and the future is free market energy. Dean, Prentiss, thank you so much, gentlemen.
Thank you, Grayson.
Awesome. Thank you so much.
Enjoyed the discussion.
Thank you for listening to the Road to Autonomy podcast. If you've enjoyed listening, please rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter at Road to Autonomy, or email podcast@brulteco.com. The Road to Autonomy is produced by Brulte & Company. The views and opinions expressed on the Road to Autonomy podcast do not necessarily reflect the views and opinions of Brulte & Company. The content discussed on this podcast is for informational purposes only and should not be taken as legal, tax, investment, or business advice.